Traders, have you ever stopped to consider what happens when a nation's top currency official turns to the world's speculators and utters the words, "This is my final warning"? That one sentence can vaporize 3 full percentage points off an exchange rate in a matter of hours. That exact scene played out today. The US dollar against the Japanese yen just delivered the most violent intraday move of 2026 so far. Well, trough plunge of a full 3%, momentarily crashing down to 155.5, a level not seen since early March. The massive downward wick you see on your screen is not a technical pattern. It is pure policy will, scarred directly into the price action, now shift to the equity market. The Nikkei 225 index closed today at 59,284.92 points, down more than 1%. Some of you might be asking, isn't a sharply stronger yen a positive for Japan? Why did the Nikkei fall? You need to understand the core logic that has governed the Japanese market for the past year and a half, the weak yen dividend. When the yen is weak, exporters rake in the profits and the stock market surges. The moment the yen starts to strengthen, that entire logic goes into violent reverse. Exporters' foreign exchange translation gains are crushed, and share prices fall in lockstep. On top of that, the 10-year Japanese government bond yield broke above 2.5% today, a level not seen in 29 years. Going all the way back to 1997. As the risk-free rate climbs, equity valuations come under comparative pressure, and capital flows en masse along the path of least resistance straight out of the stock market. Let's pull the technical picture wide open. On the 4-hour chart of US dollar to Japanese yen, the gigantic wick from 160.505 down to 155.5 has virtually erased all the gains of the past 2 weeks in a single stroke. Right now the price is oscillating violently inside the 155.5 to 158 range. Average has already been violated. The RSI has plunged from overbought territory straight into a weakened zone. Below, key support sits at the psychological handle of 158, followed by today's intraday low of 155.5. If the Ministry of Finance really deploys live ammunition intervention in the coming sessions, 155 may not be the terminal point. The 151 to 152 region is the real zone where a move like that could stabilize. Overhead, the nearest resistance is around 159.50, that is the consolidation midpoint before the intervention warning was issued, a zone now housing a massive amount of trapped long positions. Above that lies the 160 round number. Turning to the Nikkei 225 daily chart, the index dropped from an all-time high of 59,585.86 touched in the previous session, and today it gapped down further, breaching the 59,400 support. The daily MACD histogram shows a bearish crossover taking shape at elevated levels, suggesting a near-term technical bias toward further downside, potentially testing the 58,800 to 59,000 area. The fundamental backdrop demands your attention on 3 core pillars. Pillar 1. The Bank of Japan's interest rate decision yesterday. The BOJ held rates steady at 0.75%, exactly as markets expected. But the real storm is in the vote count, 6-3. 3 members dissented. Pause. The swaps market now prices a 68% probability of a rate hike at the June meeting. Pillar 2. The Federal Reserve's hawkish hold. Last night the FOMC kept rates at 3.5 to 3.75%, but for dissenting votes and the insertion of language citing energy-driven inflation sent the market scrambling to slash rate cut bets, even pricing a small probability of a rate hike by year-end. The US-Japan rate differential did not narrow further, which is exactly why US dollar to Japanese yen found support up at the 160 area in the first place. Pillar 3. The intervention expectation itself. JP Morgan strategists estimate that intervention could materialize before the dollar even reaches 162. Goldman Sachs has published a similar assessment. The last time Japanese authorities physically intervened in the currency market was back in 2024, when they acted near the 160 level and subsequently deployed over 9 trillion yen in phases over the following months. If you are heavily long US dollar to Japanese yen above 160 right now, you are effectively betting that Japan's Ministry of Finance will not dare to pull the trigger this time. History tells you the risk-reward ratio on that bet is dangerously asymmetrical. Now for the part that turns volatility into profit. I am giving you 6 strategies, integrated across both assets. Strategy 1, for a beginner in US dollar to Japanese yen. The 155 to 160 range is currently so chaotic that retail traders should not attempt to enter in the middle of the noise. Wait for a retracement into the 157.80 to 158.20 zone and consider selling the dollar against the yen there. That area is the trading dense zone from before the flash crash and is now packed with overhead supply. Place your stop loss at 160.60. If price gets back above that level, it means the intimidation effect from today's verbal intervention has entirely dissipated, and you must admit your directional read was wrong. Do not hold and hope, do not add to a losing position. Set your profit target at 154.80. Total risk on the position must not exceed 1.5% of your trading capital. Strategy 2, for the intermediate trader, aimed at the impending intervention window. You can use a plain vanilla put option on US dollar to Japanese yen to speculate on a black swan style payout. Buy an out-of-the-money put with a strike at 155 and an expiration within 2 weeks. Implied volatility has already expanded because of the intervention headlines, but it is still well below the levels you would see if actual, physical intervention were to occur. Should Japan's Ministry of Finance step into the market with real money, US dollar to Japanese yen could easily collapse another 3 to 5% within a single trading day. Your out-of-the-money put would instantly flip deep into the money, and the payoff multiple would dwarf anything you could achieve with a spot position. Worst-case scenario, the authorities stick to verbal warnings only and no intervention materializes. Your loss is strictly confined to the premium paid. Strategy 3, the professional approach, plays the interest rate differential dimension. The 10-year JGB yield has broken above 2.5%, while the 10-year Treasury yield sits near 4.5%, leaving a nominal spread of roughly 200 basis points. You can execute a rate expectation trade. Go long yen and short the dollar not through the spot rate, but by shorting a 2-year US dollar to Japanese yen forward contract. The logic, if the BOJ actually hikes in June and signals more to come, the 2-year JGB yield will climb. Meanwhile, if the Fed is forced to contemplate a hike because energy prices are driving inflation higher, Treasury yields could also rise. However, the 2-year US-Japan rate differential is currently at an extreme level of the past decade. Mean reversion probability is accumulating. Short the 2-year forward, set your stop if the spot rate trades back above 160.80, and target a move toward 151. Strategy 4, for the Nikkei 225 beginner. Against the backdrop of a sharply stronger yen, do not attempt to pick a bottom on the Nikkei immediately. You need to wait for a signal. Look for the index to pull back into the 59,000 to 59,100 area and then form a high-volume bottoming pattern. Only if the index prints consecutive hourly candles with long lower wicks below 59,100 and volume surges while a momentum divergence appears, do you consider a light trial long position using a mini Nikkei 225 futures contract. Place your stop loss below 58,600. Set your profit target at 60. Exceed 1% of your account. Strategy 5. The intermediate Nikkei trader uses an options volatility play. Today the Nikkei swung more than 600 points intraday, a clear V-shaped pattern. You can construct a long strangle. Simultaneously buy a call option with a strike of 60,000 and a put option with a strike of 58,000, both with a 3-week expiration. This is a classic long volatility structure. With the triple uncertainty of yen intervention, Middle Eastern conflict, and the Bank of Japan's June meeting compressing into a tight time window, the Nikkei has a high probability of making a large directional move away from its current range. Whether it breaks up or down, you profit. Strategy 6. The professional cross-asset trade pairs US dollar to Japanese yen with the Nikkei. The negative correlation between the dollar-yen exchange rate and the Nikkei 225 index has now reached its most extreme level in over a year. Your strategy is this: when US dollar to Japanese yen breaks below 157, go long Nikkei futures. The logic is that once the initial short-term yen buying wave exhausts itself, the yen will soften again, and the Nikkei will rebound correspondingly. Conversely, when US dollar to Japanese yen climbs back above 159.50, short Nikkei futures. The reasoning here is that the Ministry of Finance is highly likely to issue another warning or even actively intervene near. US dollar to Japanese yen has already triggered forced liquidations of heavily leveraged long positions. If in the next 48 hours the Japanese Ministry of Finance deploys real money intervention, and the probability is very high, US dollar to Japanese yen could slice through 155, 153, and 151 with zero regard for technical support. On the other side, if the Middle East situation experiences a further escalation, safe haven flows will first flood into the yen, only accelerating the speed of the dollar-yen's fall. For the Nikkei, if international oil price gains in this region meaningfully worsen Japan's terms of trade, corporate profit forecasts will face a collective downgrade, and that would be the trigger for a deeper medium-term correction in equities. Before you place any trade today, ask yourself honestly, if the Ministry of Finance launches a lightning intervention tomorrow morning, how much drawdown can your account actually survive? Let me leave you with the key takeaway. Japan's authorities have unsheathed their blade. US dollar to Japanese yen has entered a violent deleveraging phase. The yen's near-term trajectory points higher, but the political risk involved is enormous. The Nikkei is bleeding out due to the stronger yen, biased to the downside in the immediate term, yet may retain some resilience over the medium term if the BOJ's hawkish logic continues to support domestic reflation plays. Type into the comments. We will verify it together next week. Smash the like button so the algorithm feeds you more hardcore, actionable breakdowns. Subscribe and ring the notification bell. The moment Japanese officials announce substantive intervention, our update video will hit your feed. Tomorrow's preview: a subtle shift in the geopolitical landscape sparks a massive buy order in crude oil. We are going to trace who is behind the move. Same time tomorrow. We'll see you then.